Hello, welcome back to this week's market update. Today is Tuesday, September 3rd, 2024, just coming off of a long weekend and a pretty eventful week last week. So we'll jump right in. Jumping right into last week's market performance, we saw the Dow Jones Industrial Average outperform other indices while the tech-heavy Nasdaq ended lower due to a lackluster earnings report from Nvidia. As of close on Friday, August 30th, the Dow was up 0.9% on the week, the S&P 500 up about 0.2% on the week, the Barclays Aggregate Bond Index down about 0.5%, and then the Nasdaq Composite down 0.9% last week. Last week also marked the end of August. We saw August conclude on a positive note for stocks and bonds, with all major indices finishing the month higher. The S&P 500 gained 2.28%, the Dow Jones Industrial Average up 1.76%, the Barclays Aggregate Bond Index up 1.15%, and even the Nasdaq up 0.65% for the month. Heading into our economic news of the week, we got the PCE inflation report for the month of July on Friday last week, and it came in as expected, supporting the case for a potential rate cut later this month. Headline PCE showed a year-over-year inflation rate of 2.5%, while core PCE came in slightly higher, but slightly lower than expected at 2.6% from a year ago. On a monthly basis, both headline and core prices came in at a 0.2% increase, and we saw goods prices remain nearly flat year over year, while services were up 3.7%, indicating that services continue to be the primary driver of inflationary pressures. So you can see we've made a lot of progress since the peak in 2022, really working towards that 2% goal that will allow the Fed to cut rates in the coming months. Alongside the PCE inflation report, the Bureau of Economic Analysis released July's data on personal income, spending, and savings trend last Friday morning. Personal income and disposable personal income, which reflects post-tax income, both increased by 0.3%. You can see in the blue line here in the month. However, personal spending rose at a faster 0.5%, which led the personal savings rate to drop to 2.9%. In each of the past 6 months, you can see since February here, the orange line, which is spending, the increase of spending has been greater than the increase of income, which is the blue line there, leading the personal savings rate to drop. And this can be due to quite a few reasons. Maybe it's consumers having to spend more, but it could also be consumers having more confidence in the economy, feeling like they don't need to save more. Or it could be a mixture of both, depending on what demographic group they find themselves in. Really just shows a mixed picture of the economy. But the data does show that consumers' incomes are rising at a slower pace than their spending. Last week, the Conference Board's Consumer Confidence Survey showed a 1.4% rise in confidence in August. You can see that small jump there. However, they also noted that confidence has been within this narrow range over the past 2 years, so relatively unchanged when you look at historical trends. You can see since the Great Financial Crisis, we saw confidence consistently rising over that decade. Then, post-pandemic, we got a small jump up. Ever since then, it's been on a downward trend and within this narrow range in the last 2 years or so. Compared to July, consumers were more optimistic about business conditions, both current and future, but expressed increased concerns about the labor market, which coincides with that weaker unemployment print that we got for July. Confidence declined among those under 35 in August, however, it rose for those over 35. However, confidence remains the highest among younger consumers based on a 6-month moving average. So, overall, really just a lot of mixed data in consumer confidence. However, we have seen it relatively stable over the past 2 years with a few spikes up and down, showing that consumers haven't really regained that pre-pandemic confidence that they once had just about 4 or 5 years ago. Another data point from last week, durable goods orders unexpectedly rose 9.9% in the month of July, driven almost exclusively by a surge in aircraft orders. Excluding transportation, however, new orders actually fell 0.2% for the month, suggesting a less optimistic outlook for the wider manufacturing industry. Transportation equipment orders increased by 34.8%. So, again, that was the primary driver of this huge jump in durable goods orders. And that follows a decline of more than 20% in transportation orders in the prior month. So, a lot of it was just making up for a very slow month in June in transportation orders, followed by a jump in aircraft orders. So, very kind of an outlier month in the data here based on one specific industry benefiting from strong orders coming off of a weak month of orders, showing an overall slowing US manufacturing sector. Last but not least, pending home sales in July retreated by 5.5% as all four U.S. regions posted monthly drops in pending sales. Year over year, the Northeast was the only region that saw an increase, while the Midwest, South, and West registered declines. On a monthly basis, pending home sales dropped the most in the Midwest, down 7.8% in just the month, while the South followed closely, followed by the West, and the Northeast dropping just 1.4% from June to July. This month again just highlights the continued cooling in the housing market as real estate transactions have been lower on higher mortgage rates, slowing down markets. So overall, we're just seeing a slowing in the real estate market. We've been seeing that for quite some while now. However, we might see that change in the coming months as the Fed begins to cut rates. Thank you so much for tuning in to this week's market update, and we look forward to seeing you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.